While everyone's been watching China, a different economic conflict has been brewing a lot closer to home. A new trade battle with Canada isn't just political noise anymore, it's creating some serious and potentially damaging turbulence for investors who aren't paying attention. On February 1st, 2025, an executive order was signed to get the ball rolling, and by March 4, a 25% tariff hit most goods coming from Canada. This isn't a drill, it's a real issue for your portfolio. We've zeroed in on the agriculture and consumer stocks that look like they're caught right in the crossfire. Today we're going to look at which companies could be facing major headwinds, and why. The War Room Briefing. This isn't exactly business as usual. The United States and Canada have one of the tightest trading relationships in the world, with hundreds of millions of dollars in agricultural goods alone zipping across the border every day. For decades, free trade agreements meant supply chains in sectors like auto manufacturing and agriculture were woven together seamlessly. Well, that stability has taken a hit. The official reason for these sweeping new tariffs is a national emergency declaration related to illicit drugs. So, in early 2025, the administration used what appears to be emergency economic powers to slap a broad 25% tariff on Canadian imports, with a lower 10% rate for things like energy, potash, and critical minerals. Of course, Canada didn't just sit there, it fired back with its own retaliatory tariffs on a long list of American goods. Now, the situation is a bit complicated. A few days after the tariffs went into effect, goods that were compliant with the US-Mexico-Canada Agreement, USMCA, were largely exempted. That was a big deal, protecting a huge chunk, over 85% of the trade between the two countries. And in a sign of de-escalation, Canada dropped many of its retaliatory tariffs on September 1, 2025. But it's not all clear skies. Key sectors like steel and aluminum weren't exempted from the US tariffs, and Canada is keeping its counter-tariffs on those products. More recently, there have been signals that fresh, severe tariffs could be aimed at Canadian fertilizer, which would be a direct shot at a critical piece of the US farm economy. This isn't just political posturing. It's a fundamental shift in North American trade with real-world consequences. The ripple effect. So, what does this all mean for your investments? This trade spat is creating some clear winners and losers. We're going to focus on the companies that seem to be in the direct line of fire. The two sectors most exposed here are agriculture and the auto industry. Why? It all comes down to those deeply integrated supply chains. For years, companies built their entire business around the tariff-free movement of goods. A raw material might come from Canada, get processed in the US, and then get sent back to Canada as a finished product. That smooth system is now hitting some major bumps. That 25% tariff, where it applies, acts like a huge tax, jacking up costs and squeezing profits. But the damage comes from two directions. First, you've got the direct hit from US tariffs on imported parts. Second, you have the Canadian retaliation. When Canada imposes its own tariffs, like it's kept on steel and autos, American companies suddenly find their products are way more expensive for Canadian customers, which can kill demand. It's this 1-2 punch of rising costs and shrinking markets that makes this trade war so tricky for certain companies. Companies in the hot seat. We've identified 3 companies that could face significant headwinds from this conflict. Let's break them down. First up is an iconic American brand from the sector that feels most threatened, agriculture. The company is Deere Company, NYSE, DE. You see their green and yellow tractors everywhere. Deere is the world's top maker of farm machinery, but its business is pretty vulnerable to this specific trade fight for a couple of key reasons. First, and most importantly, is the talk around tariffs on Canadian fertilizer. The United States is heavily dependent on imported potash, a key ingredient in fertilizer. The US imports about 93% of its potash, and the vast majority of that, around 79%, comes directly from Canada. If hefty tariffs were placed on Canadian fertilizer, the cost for American farmers to plant crops would shoot up. When a farmer's costs spike like that, their profits get squeezed. And, when farmers have less cash, they put off big purchases. What's one of the biggest purchases on a farm? A brand new John Deere tractor. A widespread downturn in farm income would almost certainly mean lower sales for Deere. It's a simple, tough equation. Second, Deere is exposed to those retaliatory tariffs that are still in place. Canada is a huge market for US farm equipment. when Canada strikes back on certain goods, it makes Deere's machinery less competitive against other international brands in one of its key export markets. This double-edged sword puts Deere squarely in the crosshairs of this trade conflict. Navigating a trade war means staying on top of the news. This situation is changing all the time, and we're tracking every move to see how it affects investments. If you're getting some value out of this breakdown, do me a favor and hit that subscribe button for our latest analysis on how these big-picture events can impact your money. The second stock that could get dinged by this trade war is in the auto sector. Ford Motor Company, NYSE, F. The North American auto industry is the poster child for integrated supply chains. A single part might cross the US-Canada border multiple times before a car is fully built. For years, that system was a model of efficiency. Now, it's a major liability. Ford, just like other big US automakers, is getting hit by the tariffs on steel and aluminum that remain in place. Those tariffs directly increase the cost of building every single car and truck. These aren't just pennies. This is a real hit to the bottom line that eats into profits. The headache for Ford is that it can't just untangle its Canadian and US operations overnight. The company has major assembly and engine plants in Ontario that are critical for its entire North American production. Ford is locked into this cross-border system, a system that's now being taxed. On top of that, all this uncertainty can freeze investment. Automakers like Ford are in the middle of a massive, expensive shift to electric vehicles. That transition requires billions for new battery plants and factory upgrades. This trade dispute throws a wrench in those plans, with reports of automakers pausing or delaying investment decisions in Canada because of the uncertainty. For Ford, the mix of immediate higher costs, supply chain headaches, and a chill on long-term investment makes it a potential loser in this conflict. The third and final stock on our watch list is a consumer retail giant, the TJX Companies, NYSE, TJX. This might seem like a strange pick, but the parent company of TJ Maxx and Marshalls has a vulnerability that a lot of people miss. While it's a US retailer, it has a huge and growing footprint in Canada through its chains like Winners, HomeSense, and Marshalls. The risk here is tied to the health of the Canadian economy. A prolonged trade war, even with some exemptions, can create uncertainty, slow economic growth, and weaken the Canadian dollar. When Canadian families start to feel that pinch, what's the first thing they cut back on? Discretionary spending. TJX's whole business model is built on the treasure hunt experience, selling discretionary items like clothes, accessories, and home decor. A slowdown in Canadian consumer spending could directly hit sales and revenue from their hundreds of stores north of the border. Unlike a manufacturer that might be able to shift production, a retailer like TJX with a massive physical presence is directly exposed to the economic well-being of the country it operates in. Its success in Canada is tied to the Canadian shopper. This trade war poses a direct threat to that shopper's confidence, making TJX an unexpected but significant company to watch. The trade dispute between the US and Canada is more than just headlines. It's creating real financial risks for investors who aren't prepared. The imposition of tariffs and threats against key goods are sending ripples through highly connected industries. We've seen how farm equipment giants like Deere Company could be squeezed by rising farmer costs and retaliatory tariffs. We've talked about how auto leaders like Ford are dealing with profits being eroded by tangled supply chains and tariff costs. And we've uncovered how even a US retail powerhouse like TJX Companies is at risk because of its big bet on the Canadian consumer. The main takeaway here is that understanding a company's cross-border exposure is no longer optional. It's essential. This situation is fluid, and new developments could pop up at any time. Staying informed and focused on managing these kinds of risks is going to be key. What other stocks do you think are at risk from this trade dispute? Drop your thoughts in the comments below. And don't forget to subscribe for more analysis to help you navigate these choppy markets.